Welcome to this explainer. I am absolutely thrilled to unpack today's topic with you. We're looking at a truly revolutionary financial instrument that's hitting India's social stock exchange. And honestly, it is challenging everything we thought we knew about capital markets. It's a mechanism designed to formalize and bring massive scale to social funding. So grab your notebooks, get comfortable, and let's decode this whole thing together.
Okay, this right here is the fundamental question that really hooks you in. It's the core paradox of what we're talking about today. Just imagine putting your hard-earned money into a regulated security listed on a major stock exchange where you are legally guaranteed no interest, no dividend, and absolutely no return of your principal amount. No way, right? It sounds totally counterintuitive. So why would any rational investor actually do this?
Well, let's dive into it by comparing the traditional financial world with this entirely new frontier. A traditional bond is pretty straightforward. An entity borrows your money, they pay you regular coupon interest, and then they return your initial capital when the bond matures. But the ZCZP bond, it flips this entirely on its head. It offers zero monetary yield. The entire return on investment is purely measured in social impact.
Let's formally define exactly what we're dealing with. A zero-coupon, zero-principal instrument, or ZCZP for short, is a financial security issued by a not-for-profit organization on the social stock exchange segment of recognized exchanges, like the NSE or BSE. Think of it as a highly structured, heavily regulated donation. The capital you put in goes entirely 100% to a specific social cause, with literally zero expectation of financial repayment. And you know, regulators take this very seriously. The Institute of Company Secretaries of India officially recognizes ZCZPs as securities under the Securities Contracts Regulation Act of 1956. So this isn't just some casual crowdfunding campaign on the internet. By legally categorizing it as a security, SEBI ensures that this instrument is governed by the exact same massive transparency and regulatory scrutiny as a traditional corporate IPO.
Section 1. Why buy a ZCZP? Let's talk about the investor benefits.
The specific perks here are genuinely fascinating. For retail investors like you and me, putting money into a ZCZP secures standard Section 80G income tax deductions, much like a regular charitable donation, but with incredibly better tracking. But the real game changer? That's for corporate investors. Subscribing to these bonds counts directly toward their mandatory corporate social responsibility, or CSR, compliance. Plus, the 2026 MCA rules granted a massive perk. Companies are completely exempted from the heavy burden of conducting their own independent impact assessments for projects funded this way.
Which brings us to a really crucial number, 10%. Under those newly updated MCA 2026 rules, a company can legally deploy up to 10% of its total annual corporate social responsibility expenditure directly into these ZCP instruments. This opens up a highly compliant, pre-audited channel for corporate India to funnel millions into the regulated social capital market, rather than trying to awkwardly manage NGO projects in-house.
The official documentation really hits the nail on the head with this. ZCP instruments do not provide fixed interest or repayment returns, but they do promise a social return to the funder. I want to really emphasize that concept of a social return. You aren't getting cash back in your bank account, sure, but you are getting verified, measurable, and audited social change delivered right by the organization. You get concrete, absolute proof that your capital changed lives.
So where exactly does the money go? NPOs can't just raise cash for vague administrative overhead. The funds have to be deployed into eligible social activities clearly defined by SEBI. We're talking concrete impact themes here: rural education and learning outcomes, primary health care and mobile clinics, livelihood skilling for youth, and environmental initiatives like climate resilience or afforestation. You know exactly what specific theme your capital is backing.
Section 2. Who issues ZCZPs? Here are the NPO eligibility criteria.
The short answer to who can issue these is, well, definitely not just anyone. SEBI has laid down a strict velvet rope for not-for-profit organizations to ensure top-tier quality. To even be eligible to list, an NPO must be officially registered, have a minimum of 3 years of proven operational history, hold valid 12A and 80G tax registrations, and be registered on the government's NGO Darpan portal. It essentially guarantees that only established entities with real, proven track records can play in this space.
Oh, and I really want to clarify a very common macroeconomic confusion right here. Standard zero-coupon government bonds, which you've probably heard of, actually do provide a hidden yield. They're sold at a deep discount and eventually redeemed at full face value. But the ZCZP bonds on the social stock exchange? Totally different beast. They involve absolutely zero capital repayment at maturity. No hidden yield, no discount tricks, just pure impact. Section 3. Strict rules and transparency. Let's look at the governance side.
Because trust is literally the only currency here, the SEBI ICDR regulations are incredibly strict. They mandate that these instruments can only be issued in dematerialized form. That means they sit right in your digital DMAT account, right alongside your regular stocks. The rules also dictate fair allotment methodologies and clearly state that these bonds are strictly non-transferable on the secondary market. So no, you cannot day trade a ZCZP.
Another incredible safeguard built into this is the 75% minimum subscription rule. If an NPO comes to the market with a public issue and fails to raise at least 75% of their target capital, the entire issue fails and all funds must be completely refunded to the investors. This ensures that an NPO doesn't kick off a massive social project half-funded, which, let's face it, usually leads to stranded projects and totally wasted capital. Furthermore, there's this brilliant rule from the MCA 2026 guidelines regarding accountability. If a listed ZCZP instrument is terminated, let's say the project ends early for some reason, any unspent corporate CSR funds cannot just be absorbed into the NGO's general fund. They are strictly protected and must be transferred to specific government-approved funds under Schedule 7 of the Companies Act. Zero diversion of capital is permitted, period.
And the rigorous oversight definitely doesn't stop once the money is raised. Post-listing compliance is intense. NPOs have to maintain separate bank accounts specifically for the unutilized ZCZP funds. They must publish quarterly statements showing exactly how those funds are being used, and most importantly, they have to provide an annual impact assessment report certified by official social auditors. You are kept completely in the loop about the social impact being delivered.
Section 4. The path to listing. How exactly do NPOs issue ZCZPs?
So how does a great idea actually become a listed security? We can basically condense the complex regulatory checklist into 4 major milestones. First, executing the listing agreement and setting up that DMAT structure. Second, filing a draft fundraising document, which, by the way, sits open for 21 days just for public comment. Third, a rigorous 30-day review by the social stock exchange itself. And finally, the formal offer period where the public can bid for allotment.
It's also super important to note the scale required here. The minimum issue size for a public ZCZP launch is a substantial 50 lakh rupees. By setting this significant floor, regulators are ensuring that only serious, large-scale social projects with professional management make it onto the exchange platform. It's a great way to keep the quality and impact of the listed instruments incredibly high.
Finally, how does this bond actually reach maturity if there's no cash payout at the end? Well, the instrument terminates in one of two ways. Either the specific project tenure outlined in the offer document simply expires, or, and this is the beautiful part, when the social objective is officially certified as achieved by the social stock exchange. The successful completion of the social project itself is the maturity of the bond.
So the crucial takeaway here is that this mechanism entirely redefines charity. It takes the absolute rigor, the transparency, and the massive scale of traditional capital markets and applies them directly to social good. It shifts philanthropy from this sort of black box of good intentions into a heavily audited, metrics-driven ecosystem. So it really leaves us with a question to ponder. Is this radical blend of regulated stock exchanges and measurable social impact the definitive future of global philanthropy? Thank you so much for joining me for this explainer, and keep questioning how capital can truly change the world.